Welcome back to the deep dive. Today, wow, we are immersing ourselves in a really quite a collection of source material. I mean, it's a stack that goes from financial modeling, super specific real estate stuff, all the way to like urban history and even the future of connectivity.
Yeah, it's definitely eclectic. But the goal of the mission is actually pretty straightforward, right? We want to pull out the real actionable knowledge on how wealth is actually built, how value gets created, no matter what else is going on in the world.
Exactly. And for you, the listener, maybe you're trying to get up to speed fast, but, really get it. We're trying to connect these dots that usually live in totally separate worlds.
Mhm. Taking these complex ideas, things like, say, exclusionary zoning or time-weighted returns, and making them click, turning them into those aha moments that maybe help you make your next big move.
And the thread connecting all of this, we're sort of calling it the paradox of value creation. It really gets at the difference between just like hoping things work out in the
It's a
market
passive hope, yeah.
versus taking real intentional action, shaping your own financial path.
All right, whether you're, I don't know, deep in a spreadsheet calculating NPV, or you're literally transforming a rundown property, that intention, that proactivity, that seems to be the key variable across everything we looked at.
And that intentionality, it really boils down to commitment, doesn't it?
Absolutely. It's a theme that jumps out, especially from some of the behavioral stuff. There's this massive difference between being interested in something
Right.
and being truly committed. The source put it so well. When you're just interested, you do it when it's convenient, when circumstances line up.
Yeah, when it fits.
But commitment means you accept no excuses, you just focus on the results.
Okay.
So we're going to trace how that mindset, that commitment, translates into actual wealth. We're talking long-term wealth, started with the asset most people use as their foundation,
Yeah.
real estate.
Okay, let's unpack this first big idea. The choice, really, between earned income and unearned income. Earned income is what most people know, right? Trading your time, your effort, maybe your physical work for a paycheck.
Right. Your livelihood depends entirely on you showing up day after day.
Yeah, keep working, keep getting paid.
And that dependency, that's the risk the wealthy are always trying to minimize or eliminate. They shift their focus, their capital, towards owning assets, things that make money for them, even while they sleep. That's unearned income.
Okay, so stocks, bonds, those are passive, right? But you're saying real estate often becomes the focus for active wealth builders. Why is that?
Well, there are a few reasons. You can leverage real estate in ways you often can't with other assets. You can control it more directly. And fundamentally, they see a potential for huge upside with what they perceive as a relatively small downside if they manage it right.
Okay, wait a second. Small downside. I mean, didn't 2008 show us the downside in real estate can be absolutely massive, especially with leverage?
That's the critical if. The if you manage it right part.
Yeah.
Leverage cuts both ways, massively.
Right.
The downside is only small if you buy correctly, if you don't over-leverage, and if you have a long-term perspective.
Okay.
And the key is that real estate is unique. It's the only major investment that's also livable.
Ah, okay. So worst case, the market crashes.
You still have a roof over your head. It's
Yeah.
that foundational piece. The smart investor never puts themselves in a position where a market dip forces them to sell at a loss.
Got it. Which
Get it?
brings us back to that mantra you mentioned, buy it right, pay it down, pay it off.
Exactly. Buy it right means you're aiming for positive cash flow from the very beginning. That is unearned income.
And the pay it down, pay it off part?
That's about building equity and growing that cash flow long term.
Right.
Once the mortgage is gone, that income stream is pure profit, basically. Wealth generation without trading hours for dollars.
Okay, so let's talk about paying it down. Amortization. You're saying this works even if the property value itself just stays completely flat?
Absolutely. Amortization is like the silent engine of wealth building in real estate. Let's use the example from the sources.
Okay.
Say you put $10,000 down on a $100,000 property. You hold it for 30 years, make all the payments. Now you own it free and clear.
Right, worth $100,000, assuming no appreciation.
Exactly. That initial $10,000 grew tenfold just because you paid off the loan principal.
Wow.
If you calculate the return on that initial cash just from paying down the debt, it works out to roughly an 8% annual return.
An 8% return just from the mortgage payments essentially forcing you to save equity.
Pretty much guaranteed, yeah. Assuming, like you said, the property doesn't somehow become worthless, which is unlikely for shelter.
So if that return is almost guaranteed, why don't more people aggressively pay down their mortgages instead of just hoping for appreciation?
That's a great question. I think it's because people get fixated on the interest they're paying out. They don't always internalize that the principal part of the payment is actually building their wealth. It's like forced savings, but people don't see it that way.
It comes back to financial literacy then.
Totally. That's why the sources hammer this point. Financial education is way more powerful than just having money. Understanding how money works, how amortization builds wealth, that gives you power over money. Otherwise, you're just stuck chasing a bigger paycheck.
Okay, so that's the sort of passive growth from paying debt. Let's shift to the active side, forcing appreciation. This is where BRRR comes in.
Right. BRRR. Buy, rehab, rent, refinance, repeat. This is the playbooks for scaling quickly. So investors add value in two main ways, right? One is buying smart, getting a property for less than it's worth, buying equity.
Okay.
The second is forcing appreciation, physically improving the property through rehab. BRRR combines both.
And the key is doing the rehab before the long-term financing.
Exactly. You force the value up first. Then you refinance based on that new higher value.
Which means investors should actually be looking for the ugly houses, right? The dated ones, the ones that maybe smell a bit weird.
Precisely. Those are the opportunities. Average buyers get scared off, but an investor sees potential to fix it up for less than the market value increase.
Because the condition can be changed?
Condition is fixable, location isn't. That's the iron rule. You can't fix a bad neighborhood. So the strategy is often finding the worst house in the best possible neighborhood.
Got it. And that refinance step, that sounds like where things could go wrong if the appraisal after the rehab doesn't come in high enough.
That's the make or break moment, appraisal risk. The whole point of the refinance is to pull your initial cash back out, the down payment, closing costs, all the rehab money.
So you can repeat the process.
Exactly. If the appraisal is low, your cash is stuck in that property. The repeat part dies right there.
So planning the rehab scope properly, making sure it matches the neighborhood standards, that's crucial.
Non-negotiable.
Correct.
You have to know what improvements will actually add appraisal value in that specific market.
Okay, and thinking beyond the house structure itself, the sources mention enhancing site value. This sounds like curb appeal, basically.
Yeah, it's related, but maybe a bit broader. Site value improvements are often ignored, but can give huge bang for your buck, especially out in the suburbs, where the land itself can be like half the total property value or even more.
So what kind of things are we talking about?
Simple stuff, often.
Yeah.
Fixing up walkways, maybe adding or replacing a fence, upgrading the driveway, adding a shed for storage, professional landscaping.
Things that make the outside look clean, inviting, cared for.
Exactly. It signals quality and care right away, boosting the total perceived value. Smart investors will literally walk the property and make a list a dozen ways to make the site itself better. It's a direct path to maximizing profit.
Okay, moving from the physical property to the numbers needed to analyze it. Once you find that ugly duckling,
Yep.
You need to run the numbers. What are the absolute must-do calculations the sources point to? Let's start with NPV net present value.
NPV is kind of the first hurdle, the gatekeepers. It basically asks, are the future cash flows this thing is supposed to generate worth the cash I have to put in today?
How does it figure that out?
It takes all those projected future cash flows,
Yeah.
rent, maybe future sale price, and discounts them back to their value in today's dollars, using a specific discount rate, like your required rate of return.
Okay.
You add up all those discounted future values. If the total is less than what you have to invest up front, say you invest $50, but the present value of future earnings is only $47K,
Then the NPV is negative.
right, negative $3,000 in that case.
Yeah.
And a negative NPV means basically don't do the deal, or you have to go back and negotiate a lower price until the numbers work.
Got it. Okay, next metric. IRR, internal rate of return. This one confuses people sometimes, especially this idea of an optimum holding period.
Yeah. IRR can be tricky. Think of it as the investment's true, time-weighted, compound annual growth rate.
Yeah.
It lets you compare different deals fairly, even if they have different cash flows or timelines.
Okay. And the optimum holding period.
So the power of IRR is it can show you when your return is actually peaking, percentage-wise. You might model out a 10-year hold and find that even though your total profit keeps going up after year 3, your actual IRR, your compound annual growth rate, peaked in year 3 and starts to decline after that.
Wait, how does that work? If you're making more money later, why would the rate of return go down?
Because IRR heavily weights when you get the money back. Getting returns sooner juices the percentage higher.
Yeah.
Think about it. A quick flip in year 3 that gives you a 30% IRR might be financially better in terms of growth rate than holding something for 10 years that makes more total dollars, but really averages out to, say, an 11% IRR over that decade.
Ah, okay. So the peak IRR tells you the point of maximum efficiency for your capital's growth.
Exactly. It suggests that might be the ideal time to sell that asset and put the money to work somewhere else where it can grow faster again.
That definitely changes how you think about just holding forever versus actively managing. Okay, one more quick one. Cash on cash return.
Cash on cash is much simpler. It's just your annual cash flow, usually before taxes, divided by the total cash you initially put into the deal.
So down payment, closing costs, maybe immediate repair money.
Right. All the cash out of your pocket at the start.
Yeah.
If you put in $30,000 total
Uh-huh.
and the property nets you $150 a month, that's $1,800 a year.
Okay.
So $1,800 divided by $30,000,
Yeah.
that gives you your cash on cash return percentage. It's a quick way to see, is this monthly cash flow actually any good compared to how much of my capital is tied up? It's about immediate liquidity.
Makes sense. Okay, shifting gears from analyzing to actually buying. Let's talk about some specific financing tools and tax breaks, FHA and 203K loans first.
Right. FHA is huge, especially for first-time buyers or house hackers because of that low 3.5% down payment requirement. But remember, it has to be owner-occupied.
You have to live there.
Yep. And the 203K is a special type of FHA loan that bundles the money for repairs into the mortgage.
So you can finance the purchase and the fix-up all at once.
Exactly. And there are two main types. The streamlined 203K is for more cosmetic stuff, paint, flooring, fixing smells, that kind of thing. The full or regular 203K is for bigger jobs, like structural work, moving walls. But that one involves a lot more paperwork, inspections.
Sounds complicated.
It can be. Both require owner occupancy, and the complexity, especially of the full 203K, can sometimes make sellers nervous if they want a quick, simple sale.
Okay. And what about when speed is everything, or the property won't qualify for a regular loan? That's where hard money comes in, right? Sounds risky.
It definitely can be. Hard money is basically short-term financing from private lenders, not banks. They secure the loan primarily against the property itself, the hard asset, rather than your credit score.
So for flips or properties in really rough shape?
Exactly. Or if you just need to close incredibly fast to beat out other offers.
Yeah.
But it comes at a steep price.
High interest rates.
Very high. Think 12% to 18% interest, maybe even more. Plus, you'll likely pay points up front, maybe 3 to 5 points, meaning 3 to 5% of the loan amount just as a fee. Yeah. And these loans are usually short-term, like 6 to 12 months.
Yeah.
So you absolutely need a solid, quick exit plan, usually a flip or a refinance into a conventional loan once the property is fixed up. It's not for beginners.
Got it. Let's switch to the tax side. Real estate gets a lot of love in the tax code. Depreciation seems key. How does that work? It's like a phantom loss.
That's a good way to put it. Depreciation is probably the single biggest tax advantage for real estate investors. The IRS lets you deduct a portion of the cost of the building, not the land, each year, based on the idea that the structure is wearing out over time.
Even if it's actually appreciating in value and you're making money.
Even then. For residential rental property, you depreciate the building's cost over 27.5 years. This creates a paper expense, a loss, that can offset your actual rental income.
So you could have positive cash flow but show a loss on your tax return.
Absolutely. That's how many big real estate players legally pay very little in income tax. It reduces your taxable income significantly.
Any other tax things to know?
Yeah, another one is deducting points paid on a refinance. You can't deduct them all at once, but you can amortize them, deduct a portion each year over the life of the new loan. Another way to lower taxable income annually.
Okay. And when it's time to sell and you have a gain, the 1031 exchange sounds like the holy grail, but also complicated.
If you do it right, massive headache if you don't. The term the sources use is form-driven, which means you have to follow the rules exactly.
What's the basic idea?
It lets you sell an investment property and defer paying capital gains taxes on the profit if you roll those profits over into buying another like-kind investment property.
Postponing taxes, not eliminating them.
Right. But the rules are incredibly strict. The big ones are the timelines.
Deadlines.
Absolutely critical. From the day you close the sale of your old property, you have exactly 45 days to formally identify potential replacement properties in writing.
45 days. Okay.
And you have a total of 180 days from that initial closing date to actually close on the purchase of one or more of those identified replacement properties.
Miss either deadline by even 1 day.
And the whole exchange is disqualified. You owe the capital gains tax on the original sale, possibly with penalties and interest. It demands serious planning and a good team.
And it only works if you're selling at a profit, right?
Correct. If you're selling at a loss,
Yeah.
you don't, in 1031, you just take the loss as a tax deduction anyway.
Okay. Super important details. Now let's shift from the numbers and rules to the people involved in the negotiation. What really motivates a seller beyond just the highest price?
That's key. Sellers are people, often under stress. The sources highlight three main drivers. They want simplicity, they want things to happen quickly, kind of like instant gratification, and they want minimal hassle or work on their end.
So a complicated offer, even if it's high, might lose out.
Definitely. Buyers sometimes focus too much on jamming the price up and not enough on making the offer clear and easy for the seller to understand. Your offer needs to spell out very clearly. How much money are they walking away with, and exactly when do they get it? A clean, simple offer often beats a messy, slightly higher one.
And negotiation isn't just about price. What are the other levers?
The sources point to five main things. Price, obviously. Terms like financing contingencies, dates, closing date, possession date, inclusions and exclusions, what stays, what goes, like appliances or window treatments, and contingencies, inspection, appraisal, etc.
Amateurs focus only on price.
Right. Pros know they can play with all five. You might anchor high on price initially, but then be willing to give ground on, say, the closing date, or agree to let the seller leave behind some unwanted furniture.
They're using non-monetary items to make the deal work.
Exactly. Or asking for specific things to be included can sometimes extract value without changing the price tag much. It's about trading across different points of value.
Interesting. And there was a psychological tactic mentioned about getting the other side to say no. How does that work?
Yeah, this comes from negotiation psychology. It sounds counterintuitive, but asking a question designed to get a no answer can actually make the other person feel safer and more in control.
Oh.
When someone says no, they feel like they've asserted themselves, drawn a boundary. It gives them a sense of autonomy. So instead of pushing for a yes right away, you might start a call with something like, "Is now a bad time to talk about the offer?"
And if they say no, meaning it's not a bad time.
They've just said no, felt in control, and now they're actually more receptive to listening because they established their power in the conversation first. It creates a better environment for the actual negotiation.
Okay, we've gone deep on the details of individual deals and properties. Now let's zoom way out. Let's talk about the bigger forces, historical, political, architectural, that shape where value even exists in the first place.
Right, because the value of any single property is hugely influenced by the community around it. And how those communities came to be wasn't random. The sources point to influential figures back in the mid-19th century, like Catherine Beecher, Andrew Jackson Downing, Calvert Bow.
Shaping the American idea of home.
It's exactly. Between roughly 1840 and 1875, their writings really shifted attitudes. They promoted this idea of moving away from dense cities towards a more semi-rural lifestyle, bringing nature into the home, focusing on domesticity. The suburban ideal started then.
And this dream suddenly became reachable for more people.
Yeah, technology played a huge role later in the century. Streetcars were a game changer.
Making commuting from further out possible.
Right. Land further out was cheaper. Plus, building techniques like balloon framing made construction faster and less expensive.
So cheaper land, cheaper building, better transport.
It all came together. Suddenly, middle-class families could actually afford their own detached house on a decent lot outside the crowded city center. Homeownership rates started climbing.
And we saw the rise of home-style magazines around then, too.
Yeah, in the 1890s especially. They basically provided the blueprints and spread these new ideas about residential design and fashion to a mass audience.
Looking at the actual architecture from that period, there's a shift, right? From really formal styles to something else.
Definitely. Think about the earlier American Georgian style. Very strict symmetry, formal, everything lined up perfectly. It was based on Renaissance ideas coming through English pattern books.
Okay.
Then you get the picturesque styles later on, like Italianate or Queen Anne, much more ornate, asymmetrical. And then more uniquely, American styles like Shingle or Craftsman, which really tried to blend the house with the landscape, emphasize natural materials, craftsmanship, less rigid formality.
Fascinating. Okay, moving into the 20th century, things get more complicated with government policies, particularly zoning. How did that shake things?
Zoning started with good intentions, supposedly separating factories from homes, protecting public health, but it quickly became a tool for segregation, both economic and racial.
How did it do that?
Through rules that seemed neutral on the surface, things like setting large minimum lot sizes or minimum square footage requirements for houses, or outright banning multifamily dwellings like apartments in certain areas.
Which effectively priced out lower-income families.
Exactly. And historically, in many places, lower-income families were disproportionately African-American families migrating from the South. So these zoning laws made it impossible for them to live in many developing white suburban areas.
So it wasn't just about property values, it was actively creating separation. And it had knock-on effects.
Huge ones. If you legally push lower density, expensive housing into certain zones, where do the less desirable things go? Polluting industries, highways, dense, low-income housing? They often got concentrated in or near existing minority neighborhoods. This contributed directly to the decline of many urban Black communities, creating or worsening slum conditions.
And this connects to the white flight phenomenon.
Absolutely.
All right.
As zoning and other factors made suburbs more accessible and desirable for white families, often helped by federal policies like subsidized mortgages.
Like the GI Bill, but often applied discriminatorily.
Right. White middle-class families moved out of the cities in huge numbers, taking their tax base with them. The sources use St. Louis as a stark example.
What happened there?
Between 1940 and 1980, St. Louis lost almost half its population. Think about the impact of that level of disinvestment on a city's infrastructure, schools, property values. It was devastating. It shows how policy decisions can fundamentally reshape the value landscape of entire regions.
But now that trend might be reversing, this great inversion idea. What's that about?
The Great Inversion is this fascinating demographic shift we've been seeing more recently. It's the affluent, often younger, college-educated folks, singles, couples without kids, moving back into the central cities.
Why? What are they looking for?
They often value the amenities of city life, walkability, restaurants, culture, shorter commutes maybe. They're reversing that decades-long pattern of outward migration.
And the flip side is happening too, poverty moving to the suburbs.
Yeah, that's the other half of the inversion. Poverty is actually growing much faster in suburban areas now than in cities.
Really?
One source mentioned a 53% increase in suburban poverty in the 2000s, compared to 26% in cities during the same time.
Wow. Why is that significant for property values?
Because many suburbs were built assuming affluence and car dependency. They often lack the public transit, the social services, the density of resources needed to support a large, low-income population. This could create real stress on suburban infrastructure and potentially lead to declining property values in some of those areas, especially older, less connected suburbs.
Okay, so historical forces, policy, demographics, and now there's this new layer, technology. Specifically the Internet of Bodies, IoB. How does this fit in?
IoB is basically part of the Internet of Things, but focused on devices connected to the human body. Wearables like smartwatches, fitness trackers, but potentially also implants or ingestibles.
Collecting data about us.
A lot of data. Personal data, biometric data, where we are, maybe even physiological responses linked to what we're seeing or hearing, or perhaps even thinking down the line.
The sources like Rand Corporation seem to suggest this is pretty far-reaching.
It is. It's about creating this constant stream of data transmitted over the Internet. This brings this macro discussion about where we live right down to the individual level, introducing this layer of, well, surveillance and radical transparency.
How does that connect back to real estate or asset value?
Well, think about our traditional idea of a home as a private, secure space, a place to build wealth and protect your family. If we become walking data transmitters, constantly monitored and recorded by systems potentially outside our control, does that fundamentally change what privacy or security even means in relation to our physical home? The walls might be secure, but are we? It adds a whole new dimension to think about. #outro.
So after all that, this huge dive across finance, history, tech, what's the big takeaway? What does it all mean for you listening right now, trying to build real financial success, maybe what the sources call level 10 success?
I think it means you can't just focus on one piece. You absolutely need to master the details, the micro strategies, know your NPV from your IRR, understand appraisal risk in a BRRR, how to negotiate.
The nuts and bolts.
But that's only half of it. You also have to understand the bigger picture, the macro forces, how cities are changing, the legacy of policies like zoning, how technology is reshaping privacy, because those things ultimately determine the long-term value and risk of any asset you own.
It's about connecting the spreadsheet to the street, basically.
Exactly. And realizing that success here isn't an accident. And it doesn't come from just being passively interested. It requires that deep understanding paired with real, committed action. We started with that difference between interest and commitment. It really is the final word, I think. Remember, interest means you do it when it's easy.
Right, when circumstances permit.
Commitment means you find a way. No excuses, only results.
And that mindset, that commitment, that's what lets someone navigate a complex 1031 exchange on a tight deadline.
Or stick to paying down that mortgage aggressively even when spending feels easier. It's about that internal drive, that locus of control.
Okay, so that brings us to our final thought, something to leave you thinking about. Let's go back to that Internet of Bodies idea.
Yeah. If technology reaches a point where our location, our health, maybe even our thoughts are constantly tracked, recorded, stored, making us hyper-transparent.
How does that change our fundamental idea of a home, that traditional concept of a private, secure asset, a sort of castle for our wealth and family?
Does privacy become something defined purely by technology and data control rather than by physical walls and property lines? What does secure asset mean in that future?
A challenging question, for sure. Something to definitely chew on as you plan your next steps. Thank you for joining us for this deep dive.